Hey traders, this is Blake Morrow with Trader Summit, and I'm so happy to have Mr. Jim Welsh with us from Macro Tides. If you haven't checked out his website, make sure you check out macrotides.com. Good to see you.
Good to see you, Blake. Happy post-Thanksgiving. We've all probably gained a few pounds, as we should.
Yes.
But it's great to be here.
Gosh, has it been 2 weeks since we've talked? Or did we talk before Thanksgiving?
2 weeks and a day. Remember. We talked last time was November 16th.
Okay, so it
Thursday.
has.
We did on a Thursday.
I just couldn't remember, to be honest, and it's not the wine speaking.
I'm the old guy. I'm the one who's supposed to give that line,
right? You know? Yes, and obviously that's my bad. Anyway, hey, a lot's happened.
Yep.
You know, this week has been one hell of a week. We had end of month. Stocks are ripping at highs. Powell is speaking to he's at a college. And he's and he's speaking. I forget what the name of the college is.
Spelman,
that's right. And he's speaking there. He's at a fireside chat. Stocks don't really care that he's trying to push back a little bit on some of the commentary that we've got from the rest of the Fed governors about policy maybe being too tight. And I don't know, Jim, what are your thoughts here before we get into the charts that you brought?
Okay, well, at the last meeting, which was on November 1st, Powell in his press conference, and then subsequently, a number of Fed members, FOMC members, talked about how much financial conditions had tightened between July and October, and purporting, in a sense, the idea that the increase in the tightening of financial conditions represented like another 1 or 2 rate hikes. So there was absolutely no reason for them to do anything, because in effect, the financial markets were tightening policy for them. So I think people have forgotten that, because what we've seen, and we're going to look at a chart of financial conditions in a second, they've eased very significantly. I mean, we've seen a big rally in the S&P. The 10-year yield's gone from 5 to 4.25. The dollar's come down a bit.
Yeah.
Credit spreads have narrowed. So my point is, one of the things Powell talked about was they wanted to see financial conditions tighten, and then tighten for an extended period of time. In other words, this wasn't what they were after. That's exactly what they've gotten. Does that materially change anything? No, the Fed's not going to do anything in December. But I think potentially the bias to potentially raise rates again is still present. And markets have assumed that the idea of a rate hike is out of the question. And now all we're focusing is how soon we're going to see rate cuts. And I just think Powell's speech today, he said it's premature to assume that policy has become restrictive enough. It's premature to start guessing when rates are going to be cut. And if necessary, we're prepared to raise rates again. So to me, what will be the litmus test is how much softening do we see in the first part of next year? And if we don't see a whole lot of softening, I think you'll see Fed people starting to push the idea, well, we may have to raise rates again. And conversely, if the economy slows materially, I think they're going to be reluctant to quickly come to the rescue. They're looking for things to slow down. They're not going to, oh my God, it's slowing. No, this is what they've been working toward. So I don't think they're going to overreact at the first signs if we see meaningful slowing. So that creates a window where and again, I'm in the camp that we're going to see the economy slow materially in the first half. I think the potential for one negative GDP quarter is high. So I just think that the Fed is going to be resistant to cutting rates as soon as Wall Street would like them to. And that could create a window of vulnerability for the S&P. And it might only last for 2 or 3 weeks. But, we've seen this. In 2 or 3 weeks, the S&P can peel off 10%. And so that, to me, is the risk as we go into next year. Wall Street, though, is having none of it. Their idea is, hey, it's just a question of when the Fed cuts rates and there's no recession on the horizon, earnings are up 12%. I mean, that's like as good as it gets. And so to me, a lot has been priced in terms of equities in anticipation of all this good stuff. And that means it's time to, in my view, become a little bit more cautious.
Well, you talk about, it's the fact is that the Dow is less than 2% or about 2% from all-time highs right now.
Yeah. And you know what? There is the potential. I can make a case that the S&P will go to an all-time high by early next year. Because again, the mindset here is we don't have anything to worry about. Well, that means most people, why would I want to sell? If I think the economy is going to, be growing enough to generate 12% increase in earnings, and the Fed's going to be cutting rates. So when you have a lack of selling pressure, it doesn't take much buying pressure to lift prices. Conversely, what we saw in October, a lot of negative news. Oh my God, the 10-year's at 5%. It's going to 5.5%. Oh my God. Well, it doesn't take a lot of selling pressure to drive prices lower, because people are standing aside. They're not, the volume of buying is diminished in that environment. And so that's the big swing factor when you get a narrative that becomes dominant.
Yeah.
Is that it doesn't take a lot of volume one way or the other to push prices pretty far. And, that's where we're at. So I can make a case chart-wise where, we're setting up for a pullback, but that there's another push higher into early next year that potentially the S&P could make a new all-time high, then or above the summer high. The NASDAQ 100's already done it, and that's been the strongest average. Yeah. So it's going to be a little tricky, I think, over the next 6 weeks.
Well, let's start off with some of the charts and information you brought today. So let's just go let's go in that direction. Yeah. You were talking about financial conditions. One of the questions that I had for like my team members were, what happens, as stocks continue to rally, financial conditions continue to loosen, then that's not what the Fed wants to see, right?
Well, it's counterproductive. I mean, to the extent that, financial conditions are based on stock prices, okay? Treasury yields, well, we've seen this big drop in Treasury yields. Well, what's happened to mortgage rates? They've come down. That's going to spur some increase in activity in terms of housing. The dollar weakening is beneficial in terms of making U.S. products more competitive overseas and so forth. So what you can see is huge increase in financial condition, the tightening of financial conditions between July in late October. Well, we retraced about 65% of that tightening. So to the extent that everyone was, the Fed can't do anything, financial conditions are tight. Well, wait a second. The Fed is going to be looking at this and saying, whoa, the markets have eased financial conditions significantly. And, to me, that increases the odds that the bias toward an additional rate hike goes up when you see this kind of improvement in financial conditions, all else being equal. So I just think, to your point, that and I think the December 13 FOMC meeting, not going to raise rates, but I think there's a good chance we'll see some pushback, by a number of Fed members talking about the increase in liquidity that the financial improvement in financial conditions have provided and so forth. Just some pushback to this kind of galloping idea that the Fed is, it's just when they're going to cut rates. And the next chart goes to that point. This is the Fed funds futures, and effectively they're pricing in 5 rate cuts next year, starting March maybe or May.
Jim, can I ask, what has to happen for the Fed to cut rates at this point? Like, what, in your book, what has to happen?
Well, I think you need to see a fairly significant increase in unemployment. The drop in inflation obviously is wonderful, but as we've talked in recent months, the Fed's not looking at just 2024. They're looking at 25 and 26. Yeah. And the idea being we want to create enough slack in the overall economy and the labor market so that when we do cut rates and growth starts to resume, we're not going to bump up against capacity utilization, tightness, labor market tightness that causes wages to begin to tick up, because that's going to be problematic for keeping inflation down over the next 2 to 3 years near their target. And so to me, the idea that we're not going to have a recession, but the Fed's going to cut 5 times, I just find that unlikely.
Yeah. All right. Well, let's. Yep. I kind of feel that way too. Did you want to continue on?
No, because the next chart,
okay,
I think provides. I mean, this is a crazy chart, and you'd have to kind of study it for a while. So that's why at the top, what I'm explaining here is if you look at this chart, the CPI, core CPI is the left scale, and the unemployment rate is across the y-axis at the bottom. And so these are when the Fed cut rates. At what level was unemployment? Well, in 1974, that's a nice, easy one. The unemployment rate was about 8.5%, and inflation was about 5.5%. So the Fed has never cut the funds rate going back to 1960, when the core CPI was above 2.7%, and the unemployment rate was under 5%. All right. Well, where are we now? Well, the core CPI was 4% in October, and the unemployment rate is 3.9. So again, if we look at history, and we've just gone through, a lot of these other periods, like 2001, and other in 1989, 87, those were periods of relatively low inflation. We're just exiting a 40-year high in inflation. So to me, that makes the odds of the Fed, let's cut rates, even though the core CPI is above 2.7 and the unemployment rate's below 5%. It just doesn't add up. And to me, this reinforces that point by looking at, well, what historically has happened.
Okay, that makes sense. I mean, so what you're showing here on this chart, and I just want to be clear here, in 2019, CPI was slightly above 2%, and unemployment was low, and the Fed cut.
Right. But because inflation was well under 2.7, I mean, it basically was at their target of 2%. Now, again, I wish whoever did this, I wish they had done a second chart showing core PCE inflation, because the Fed pays more attention to core PCE, but this is where the chart is, and it still, I think, makes the point. So in 2019, they cut because inflation was exactly where they want it to be. They had and that was after about 8-9 years of inflation holding right around 2%. So in their mind, inflation expectations are really, really well grounded and so forth.
Yeah.
Pricing power. Interestingly enough, I heard Harkin, I think it was, one of the Fed members, I can't remember if he's Philadelphia or wherever. Anyway, bright guy. And he said, what I'm hearing is that companies are raising prices because they can't. And in part, they went through a decade where they couldn't raise prices. So it's like wandering in the desert looking for a glass of water. And then all of a sudden the pandemic shows up and you have a lot of pricing power and you're using it. And there's some need to it too, because your costs have gone up a lot.
Yeah.
And what he was implying is that there's a lot of companies that are still, if you will, testing the market's willingness to absorb higher prices. And they're still getting it. He said they won't stop doing that until their revenues, soften, and they're forced to fight for market share. And so he's one of these guys in the camp of, I'm not yet convinced that inflation is going to go down and then stay down. So he's not a voter this year. I have to look up to see if he's a voter next year. But the topic and the way he presented it, to me, makes an awful lot of sense of what's happening. Well, that argues that inflation has come down a lot because of the unwind in energy costs, and used car prices are coming down. But that core inflation, it's going to get tougher and tougher to bring it down. As much as we've seen over the last year, it's just not going to be repeated. So again,
we're in that last leg of the marathon, right? I mean, and it's not the easy part.
Yeah, you're winded, you're tired, assuming you're going to actually make it to mile 23.
Right.
Anyway, so again, the point being is Wall Street has these expectations: 12% gain in earnings next year, and the Fed's cutting 5 times. I mean, that's like somebody saying you can eat as much ice cream as you want every single day of the year, and you're not going to gain an ounce.
Yeah.
Well, can I have
Perfect
some
world,
salt
Jim.
on that ice cream?
It would be a great, rainbows and unicorns are always nice to see. So
They really, truly are.
all right, Jim, the next chart you brought is regarding yields.
The 10-year.
So tell us
Yeah.
why you're showing us this. I mean,
well, basically,
down, obviously.
in late October 23rd, I recommended, my take was when we were talking, I think yields are about to come down a fair amount. That was at a time when the 10-year got to near 5 and people were somewhat hysterical. Oh my God, it's going to 5.5. It may go to 6, And to me, the price pattern indicated that, okay, we got 5 up, time for yields to come down. And then it was a question of, did they come down in a 3-wave pattern or 5? Well, as best I can tell, they've come down in 5 waves. So that implies that we're going to see in the near term, yields tick higher. But then ultimately, we're going to see yields come down again below 4.25 at some point in time. So I'm just looking at it and saying, near term, we've had a heck of a move. On Monday, I recommended selling TLT on Tuesday because it's like we've had this big move. It's time to just stand back and let's see what happens. The bottom panel is the MACD on the 10-year yield RSI. So because it's yield, not price, it's kind of inverted. So you can see it's been it looks like it's, curving and it's about to turn up just on that indicator. So I think the odds are that we're going to see the 10-year yield. It drops 75 basis points. So could it increase by 30 basis points, 25 to 30 basis points easily over the next week or two? So again, the idea is to try to identify intermediate swings and not try to be too perfect. So we were able to capture a big chunk of the rally in Treasury bond prices via TLT and, basically, and the idea that yields were going to come down was going to be supportive of a stock market rally.
Yeah.
So anyway.
And they have been.
Yeah.
I mean, they truly have been.
With the most interest sensitive sector, meaning the mega cap, they've responded just like they have over the last 18 months. When yields went up a lot last year, they got crushed, and they've rallied most strongly whenever we've seen a period of declining rates.
So, the next chart you brought up, Jim, is the interesting. You're bringing up the Russell 2000. Why are you bringing the Russell? Whoops, let me clear that.
Well, it's been the pattern that the Russell has presented over the last 6-8 months has been extraordinarily clear. At least I thought it has been. All right. So from that high in late July, you can see 1, 2, 3, 4, 5, the green numerals. So that was one of the reasons why in October, it's like you got 5 down on the Russell, you got 5 down in the value line composite, the equal weight S&P 500, the New York composite. All these averages have 5 down. Now, longer term, to me, that provides a negative message. But near term, it meant we're going to have a pretty decent rally. And, I think this rally is an ABC, a counter trend rally. I think we'll see a pullback in the not too distant future. And the nature of that pullback will be very instructive. If it's just 3 waves, ABC down, we're going to have another push higher. If it's 5 down, that'll be a different story. On Monday, I wrote that I thought the Russell would exceed 1830. It looked like it just needed. We're doing that today. And the 618 retracement of the decline from the high in July to the low in October comes in at about 1866. But, for me, it's like time to sell into the strength. In other words, in October, it was like time to buy. We're going to get a rally. And now it's, I think, time to say, you know what? I think the upside offers less potential than a potential pullback could, provide.
So let me ask you this question before we move on. The Russell 2000, obviously the laggard of the indexes. You've got, the Dow that's almost at all-time highs. NASDAQ 100's just ripping. You got the Mag 7 still looking pretty damn good. Would you be selling those that you feel that are overbought, or would you be preying on the weak here and selling, the Russell?
I'd be selling both of them.
Oh.
Because if I'm right about Treasury yields ticking higher,
Mm-hmm.
I think that provides an excuse for people to take money out of the Mag 7. And I think the pattern in Russell, it just implies that it's going to have a pullback. I have no idea how deep. What I will say is the momentum indicators that I use to try to make intelligent guesses, are still in pretty healthy condition. And so that's why in this environment, it's like, okay, there's not enough deterioration to have confidence, at least for me, that, we're about to have a 3% pullback.
Yeah.
I think you have to give the benefit of the doubt of these retracement levels, like on the Russell being 1866, that you can reach those retracement levels. And then as we get closer, if the momentum starts to really deteriorate, that's when the synergy between, okay, we're getting near a retracement level and we're starting to really lose internal strength, then I would feel more confident, like saying, okay, this thing is running out of fumes. We're definitely going to have a pullback. And again, to the extent that Powell pushes back on this optimistic view of 5 rate cuts next year and so forth at the December 13th conference. So I think the market could potentially, Blake, hold up going up into that window right before Powell, and then he throws some cold water on it. So, anyway.
Well, the index, one of the indexes that's doing really well is the S&P. You have the S&P here that's closing in on that 4,600 level. Matter of fact, we are a hop, skip, and a jump away, a little higher than where your chart is. You brought.
I put these charts together about an hour ago.
Yeah, and we are a little bit higher. So, what are your thoughts here?
Same thing. You can see from the low in October, a little up down up for A, or down up down for B. If A and C are equal, it targets 46.33. So again, the momentum indicators are still pretty healthy. So I have to respect that the S&P can make a move up to 46.33 or somewhere near that. And getting above 46.07 now to get even more people bullish. And we've seen a significant shift in sentiment. In October, uniformly, people were very negative and pessimistic. Oh my God, the 10-year's going to 5.5 and God knows where else. Yeah. Now we've seen a complete opposite, where a number of the sentiment surveys show people are pretty giddy about stuff. It doesn't get any better than earnings growth and rate cuts.
Right.
It may not compute, but as long as people believe it, they're not going to sell. And, so to me, we're nearing the end of this initial move off the low. Then it's a question of, there's a big gap there, and I can't see the price because I don't have my glasses on.
Over here, it's going to be around 44.20 at the edge.
So to me, that would be an obvious place to look for some kind of a pullback, and see if the S&P closes that gap. And then again, it just comes down to, if it's an A, B, C down to that level, hey, we're going to new all-time highs. If it's a 1, 2, 3, 4, 5, then we get a bounce, and then the market's going to unwind. For me, there's no way of knowing. All I can do is say, all right, I thought it was a good time to buy when the S&P was below 41.50, and we talked about that. And now I think you've seen most of the rally. It may be able to pop to 46.33, but I do think there's a pullback coming. And the nature of that pullback will tell us whether we want to buy that dip in anticipation of the S&P going to a new all-time high, or if it's 5 waves, then it's like, okay, wait for the next bounce and look to go short. There's no way of knowing.
Well, maybe there is.
I don't know.
Maybe it's in your next chart, Jim. You got the dollar index, and looks like we just completed 5 wave down.
Yep. And when we last talked on November 16th, the labels were A, B, C, down to where the number 3 is. Well, then we got a bounce, and then went into lower low. So when I look at this chart, to me, it looks like you got 5 down. My conclusion then, if this is correct, the next rebound in the dollar index will not get above the high at 107.34. It will be a retracement. And then I think, and I've been saying this, we're likely to see the dollar below 100 in the first half of next year. That we're going to go back down to the lows that we're seeing in July. And again, I think that's going to be predicated on the economy showing more weakness than people presume and how that will alter monetary policy. But right now, you got 5 down, there should be a bounce in those two targets, 104.90, 105.48, or just, okay, how deep of a retracement? I like the idea of getting up near 105 just because you can kind of see that was kind of a pivot area a little bit.
Yeah.
That it would make sense to go up that far. So that's, and you can see the bottom panel showing the RSI. The RSI on the dollar got down to 30, just below 30. And the last time it did that was July, which again, you and I were talking back in July. It's like, okay, a rally to 104 is coming. And most people at that point in time were talking, well, the dollar's going to lose its status as a reserve currency.
Right.
It's amazing how this crap comes out of the woodwork at inflection points.
Sure. Yeah, of course.
Anyway.
Of course. Always does. All right. And so the last chart you brought up for us, Jim, is going to be the gold chart. We got a lot of gold bugs listening in, believing that gold's going to hit all-time highs. So what are your thoughts here?
Well, that's been my view, is that there was a wave one rally off the lows of last year in October to the 2070 high or whatever it was, or maybe it was 2057. We had a wave two pullback under 1850, which you and I discussed at length. And to me, that initial rally from the low at 1812 to 2008 was wave one of what I think could be wave three. We had a pullback to 1933. So we're in what should be wave three to the upside. And yes, the chart pattern to me suggests that gold is likely to push higher. And if it breaks out above 2070, a measured move would easily take it north of 2100. So you could see a really sharp spike in the next week or two. And that's been my expectation, that we were going to new all-time highs. And I think next year, if I'm right about the outlook for the dollar dropping down below 100, I think gold has the potential to trade above 2,300.
Wow. That
well,
would
we'll
be
see.
that. I'm gonna leave it there for all the gold bugs to think about. So
glitter.
Yeah, that's it. All right, Jim. Well, I tell you, it's nice to have you back. I'm glad you had a great holiday. And thanks for guiding us each and every week.
Hey.
And now, remember, if you like what Jim does here, make sure you give him a thumbs up and subscribe to the channel. But more importantly, you should reach out to Jim and check out his work. How do we do that, Jim?
Well, macrotides.com. There's some information there. You can kind of review what my calls have been over the last few years on the dollar. I mean, obviously, we've done these videos for a long time now.
Yeah, years.
Documentation of stuff. But they can find out, okay, what has his outlook on various markets been. There's a recap piece that the overview people can look at and read. If you want a recent publication, Jim Welsh Macro at Gmail, and I'll send you one out so you can kind of see the detail.
Make sure you guys don't sleep on that. So, Jim, thank you so much for being with us. I'll look forward to our conversation next week, and I hope you have a wonderful weekend.
You too, Blake. Thank you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.